Hey, what's up? This is Greg. Welcome to the channel. On this video, I'm going to talk about an option strategy where you can make monthly income selling puts and calls. And I call this strategy high probability options trading. And as you go through this video, you're going to understand why, and be sure and watch it to the end, because I will be giving you the full strategy and the way you can make rather extraordinary monthly income with this trading strategy. Okay, so I'm going to divide this video into three sections. The first section is going to be going over some basic options terminology and some basic concepts that you need to know to understand the strategy. The second one is going to be basically a description of the strategy. And then the third section is we're going to go into my trading account and we're going to look at some possible trades and analyze some possible trades so they can understand how the whole thing works. Let me say at the outset, this video is not intended to be a complete course on options in general. Options are a topic that is very complex. There's a ton to know about options trading. I could never do it in one video. Quite honestly, there are people out there that know a lot more about options trading in general than I do, but I know a lot about this specific strategy, which I've tested over many years, and I know that it works. Okay, so what is an option? An option is basically a contract between two people, two individuals, where I, as the option writer, am agreeing to either buy or sell you a particular security at a particular strike price, and that option contract has a defined period of time. Now, the strike price is the price at which the contract specifies where the securities will be either bought or sold and at what price. Okay, the strike price is basically the price that the securities will be sold within the contract. There are two main characteristics of an options contract. One is time value and the other is intrinsic value. These are two things that you need to know to understand this concept. There are many other aspects of options characteristics, such as implied volatility and things of that nature. A lot of theory here. The Black-Scholes theory, it's very complicated. People write PhD theses, I think that's the way to say it, on this subject. So we're not going to delve into all that, but for the purposes of this strategy, you need to know the concept of time value, which is the time period from today to when the option expires, and intrinsic value is the amount above which the underlying security's price is above the contract price. Now, time value is called theta. Okay, so it's important to understand that in this particular strategy, what we are going to be doing is selling or shorting time value or theta. With any options contract, from the time that it is initiated until the time that it expires, the strike price is either below or above the value of the security. The time value of the contract is the time between today and the expiration of the contract. And as the life of the contract progresses, meaning the closer you get to the expiration date, the time value decays more and more rapidly the closer you get to the expiration date. The other concept you have to understand in this strategy is the concept of standard deviation. Now, for the purposes of this method, we're using standard deviation to calculate the probability of success in a particular trade. Now, I'm not going to go over all the ins and outs of standard deviation. It's a statistical measure, and it is used to calculate probability. That's really all you need to know, but we're going to refer to that later in this video to calculate the probability of success of a particular trade. Now, in this strategy, we are going to be selling or shorting puts and calls. Okay, now this can be done one of two ways. You can do it either as naked puts or calls, meaning you're doing it in an option account, or they can be covered, frequently calls. You can have covered puts too, but covered calls. Or you can have a cash collateralized position, which means that you keep enough cash in your account at all times in case you get assigned, which is where you are required to either buy or sell the security. You keep enough money in your account at all times to cover that potential obligation. Collateralized calls are done in a normal account. Naked calls and puts are done in a margin account, and that is when you do not have in the account enough equity to cover the eventual assignment if it ever happens. But it's important to realize or point out, in this strategy we are going to do everything we can, and it's fundamental to the strategy, to never get assigned. That is like the last thing we want to have happen. Okay, now why do we want to sell options as opposed to buy options? Frequently, inexperienced traders get their first taste of options, so to speak, by buying options, right? They are in the position of being the speculator. They are buying an option in the hopes that the underlying stock will go up, and if they buy out of the money options, say, they're hoping that the underlying stock will go higher than the strike price, so that they have an in-the-money option and they make a ton of money. And the reason people want to do this is because you can get a tremendous amount of leverage. The reason I don't like doing this is because most option contracts expire worthless. Okay, now, you know, you hear numbers floating around, oh, 90% of options expire worthless, 80% expire worthless, 40, 50. The truth is, it varies, okay? But I can tell you from personal experience, when I've tried to speculate in options, and when you're buying options with the expectation that they're going to go up in value, you're not doing anything more than speculating, and you can lose 100% of your investment. But what I've learned from trading options in that way, which is the way most people get into it, it is extremely risky because you have to be right within a defined period of time. Okay, now there are all kinds of option strategies where you can reduce your risk. I understand that, but in general, buying and holding options is extremely risky, and I have made and lost a ton of money doing this. But in my experience, maybe I'm just not a great going long options guy, but in my experience, I've lost as much money as I've ever made. It's been a zero-sum game, basically. The reason I like selling options is because now, instead of being the speculator, you're the house, you're the casino. You are essentially selling the speculator either an option to speculate with, or in many cases, options are used as insurance to protect a portfolio from going down in value. Okay, so it can be used as a hedging mechanism, or it can be used for speculating. But when you're in the position of writing the put or taking the other side of the transaction, you are in a much lower risk transition because the probabilities are in your favor. And in this strategy, you're going to see how you can increase the probability of success to the point where it is a relatively low risk strategy. As I said at the beginning of the video, the strategy here is selling puts and calls that are deeply out of the money. What does this mean by deeply out of the money? Okay, let's just talk puts, okay, for the purposes of simplicity. In the case of selling a put, you're selling a put where the strike price is very much below the actual price of the underlying security at that point in time. And what we're targeting in this strategy is that there will be at least a 90% probability, when you go into the bell curve and you look at the standard deviation calculations, there will be at least a 90% probability of that option expiring worthless. The way you can implement this strategy, you can do it two ways. You can do it a more conservative way and a way that involves a little bit more risk. The conservative way is to do collateralized puts and calls, And in that situation, you're always keeping enough money in your account to cover the purchase or the sale in case you get assigned, meaning that you have to live up to the contract at the end of the expiration. And the other way is to do it in a margin account where you have to put up less money, but it is more risky, because in the case that you do get assigned and you don't have enough money in your account, technically you can get completely wiped out, okay? But there are risk mitigation techniques that I'm going to talk about that will vastly mitigate that risk. Now let me emphasize one thing. In this strategy, you want to avoid getting assigned at all costs. I've heard a lot of people on YouTube talking about selling puts and, oh, it's a terrific way to buy stock cheap and all this kind of stuff. Of course, they're talking about situations where you're fully collateralized. But in those strategies, you don't mind owning the shares, so you're selling the puts at a tighter spread between the underlying price of the security and the strike price, so there's a higher probability that you will get assigned. It's a different kind of a strategy. It involves, in my mind, a lot more capital, and it's risky. In this strategy, you do not want to get assigned under any circumstances. Okay, now another aspect of this strategy is you are going to be selling puts, you're going to be selling calls, and sometimes you're going to be putting on what's called a strangle. So in a strangle, you're selling a put and a call with a spread, and both the put and the call have the same expiration date. Of course, they have different strike prices, but they have the same expiration date, so that the underlying security could trade anywhere in between those 2 points, and you don't care. You don't care if it goes up, you don't care if it goes down. It's within that same range, and if it stays within that range, you're going to keep the full premium. Now, another aspect of this is which kinds of underlying securities do you want to sell, okay? Again, a lot of people do a lot of different things. People sell puts and calls on individual stocks. They do them on indexes. They do them on ETFs. What I like to do, and what I would recommend in any small retail account, is to sell not individual stocks, because I think that's much more risky, because, you know, what if you have a bad earnings report? You can get completely burned on that. There's a lot of things that can go wrong when you're doing underlying stocks. I like to do ETFs, and really the only ETFs that I would consider is the SPY and the QQQ. Okay, I personally prefer the QQQ because it's a little bit more volatile. It basically tracks the NASDAQ 100, and I've gotten very used to trading that one. It's got slightly higher premiums than the SPY, and therefore I think it's more lucrative, and I just find it very easy to trade, and so that's what I would recommend. Okay, one more comment before we go into the trading account. What you're doing with this strategy where you're selling calls and puts is you are essentially writing a contract, initiating a contract, or selling to open at a particular expiration and a particular sales price, okay? And it's driven by the market at that particular point in time. What you're doing is you're collecting a premium, right? The premium's going into your account. The premium stays in your account, frequently in a margin account, until you close out the position, okay? So you're receiving money, you're keeping that money until you close out the position, which would be basically either the contract would expire or you would buy back the position. Okay, so I think the best thing to do right now is let's dive into the trading account, and I'll give you an actual example of what I'm talking about. Okay, here we are in the Options Analyzer tab in my E-Trade account. Now, just a quick word on the best platforms to trade in. I use E-Trade. I've used E-Trade for a long time. Doesn't mean E-Trade is the best platform for options. I personally think that TD Ameritrade Sink or Swim is probably the best for options, but you know, there's probably more out there, so I'm not rendering an opinion on that. I just use this because I'm used to it, and it works nicely. So I'll demonstrate on this and we can take it from there. All right, so here we are. We have the Invesco QQQ teed up here. This is today's price where it closed. So first we go down and we pick a strategy, and we're going to keep it simple. We'll just do a put strategy. And you can see here that what we do is we sell to open, right? We'll just do one contract. We're doing a put. Now let's set the expiration out at August 19th, 22. Now just a word on this. Statistically and probability-wise, it's been proven that the greatest decay in the time value begins around 60 days, 56 days. I like to use between 60 and 50 days in this strategy because I find that after that time period, the time decay, which works to your favor since you're short, accelerates the closer and closer you go from that point to the expiration date. You can also get the highest premium versus the rate of decay, if you understand what I mean, during that time period. So this is roughly within that time period of what I'm talking about. Now, I did this a little earlier, so let's go to 225. Okay, and you can see over here, this is the premium that you can receive, right? It's multiplied times 100. So for every one contract, you're going to get $156. Okay, and you can do the math on that. If you do 10 contracts, it's over $1,500, etc. Right? So let's hit Analyze, and this pops us down to the standard deviation chart, right? And this calculates the probability. Here you see the strike price. We know what the expiration date is. This is where the market is currently trading on the underlying. And if we go down here, we see the expected probability of this trade is 97.5%. Now, I'm no genius, but those are pretty good odds, okay? This says that based on probability of the price movements in the data set, that there is a 97% probability that this, on the expiration date, this contract will expire worthless and you will make the full premium. Now keep in mind, you can cover any time from now until the expiration. You can cover or buy back the contract any time during this these prices here. So you don't have to wait to expiration. You can buy it back 10 days before maturity if you have a nice profit in there. But one of the things that you can do to increase the return, and also if you're doing this in a margin account, you can reduce the amount of margin that's required, is by doing what's called a strangle. And let's talk about that right now. Okay, let's go back to here, and let's change the strategy to a strangle. All right, so in the strangle, we're going to sell to open a call, and we're going to sell to open a put. Okay, we're going to set the same expiration date, August 19th. Okay, and in the case of the put, we will put the same 225 that we had before. Okay, so what we're going to do with the call is we're going to set the strike approximately 15% above where the stock is trading now. The reason that we're doing it at a lower percentage than the put is simply because markets have much more of a tendency to melt down than melt up. And as the market increases, you'll have more time to get out of the position if it's going against you, okay? So let's take a look at this. We have August 19th, and so we're selling one call at 325, and we're selling a put at 225, okay? So let's analyze. Okay, so this is what it looks like. We're slightly above 1 standard deviation to the upside, and we're still down around 2 standard deviations to the downside. And the reason we do this is because, number one, your brokerage will require less margin if you're doing this in a margin account, so your return will be higher. But the other reason that your return will be higher is this right here. You can see that you're getting 2 premiums from selling this strangle, right? So you get a lower margin requirement and a higher return, okay? So let's just do some quick math here. On this one, if you do some quick math, and I'll do it in more detail in a minute, but if you do the time period and you calculate the return, it's over 5%. It's almost 6% here versus what you had to put up. And if you calculate the time period that was involved, your annualized return will be over 40%. Okay? And with this strategy, I've seen returns, again, in a margin account, anywhere from 30 to 60% annualized. Okay? And it depends on a lot of different factors. One being where the VIX is at. And one thing I want to mention is that a lot of this strategy depends on where the VIX is trading, because the VIX is really a measure of fear in the market, and it's a options-derived measurement. And so as the VIX is higher, premiums will be higher, so you will be able to get more premium for every trade the higher the VIX is. All right, let's go back to the main screen. Hey, so if you're getting value out of this video, please like and subscribe. And if you subscribe, please give me a comment below, give me a shout out, and I promise I'll answer either your shout out or your question. If you subscribe, I greatly appreciate it. Okay, so let's just talk about returns for a second, okay? Let's do the following calculation. All right, let's assume that in the case of the 225 strike price on the put that we talked about, if you had it fully cash collateralized, you'd have to have $22,500 in your account. In the case of margin, let's take the 20%, and that gives you $4,500, and then we subtract the option premium, and we get $43.44. And if we just do the math on that, we take the premium that we collected, $156, divide it by the $43.44. That's a 3.59% return for the 50 days. And if we, which would be the period for which we were selling, the theta period, and we divide that 50 by 360, it gives you a 25% rate of return. Okay, so take the situation where we sold the strangle. So we sold the call and the put, and you don't have to do this at the same time. Actually, I would recommend selling the call on up days and the puts on down days, because that way you maximize your premium. But anyway, so you get the benefit of less margin requirement, which I'm not including in this analysis, but it would look something like this. So you have the 284 premium combined, you divide it by the margin requirement of 43.44, that would yield you 6.53%. You divide that by 50 days in a year, 50 divided by 360 is the way I do it, and it comes out to a 47.1% annualized return. Okay, so I just want to point out, if you can do this consistently, either on a collateralized basis or with margin. They're very good returns. This is cash. This is cash that's coming into your account every 2 months. But once you get it set up, you stagger it so that it comes in every month, and you can make a very nice compound rate of return. Now the question is, how much money do you need to get started with something like this? Okay, you could do it with as little as $10,000. Okay, but I would recommend, if you're really serious about it, you need at least $25,000 to get started, and I would prefer $50,000 so that you could take on some meaningful positions. Okay, now just a word of caution. This strategy, while it is a high probability, relatively low risk strategy, because you are selling such deeply out of the money puts and calls, that there is a very high probability that you're going to make money here, but there is a chance that those trades will go close to, or even in some cases below, God forbid, the strike price. What you need to do with this strategy is you need to be alert and you need to be aware of what's going on in the market. This is not a set it and forget it type thing. Over a 4-year period of monitoring my trades on this kind of a strategy, there were only 2 or 3 times when I lost money. And those were periods where the market declined rapidly and I panicked, and it looked like it was getting rather close to the strike price. It actually wasn't even that close to the strike price. But I panicked and I covered and I took the loss. Okay? That's what you're supposed to do. But in those cases, in all 3 of those cases where I did that, had I not done it and had I held on, it would have expired worthless. So I kind of panicked there, but I really think that once you start getting close to your strike price in either case, to be just sure that you're not going to get into trouble, I would take the loss and live to fight another day. And this is a risk control strategy that I would highly recommend. But other than that, this is a relatively low risk, believe it or not, conservative strategy. And if you implement it consistently, you can make a lot of money. And if you do it in a serious way, you can really, literally turn it into a business. I think of it as an insurance business where you're basically selling insurance and you're managing risk, and you're performing a function within the market that is needed and that is sought after by both speculators and investors. So I hope you enjoyed this video, and if you did, please like and subscribe. And if you subscribe, put a comment down below and let me know that you subscribed, and I promise I'll answer you on the comments. And don't forget to hit the bell so you can get notified every time I come out with a new video. On this channel, we do investing, we do the markets, we talk about the economy, we talk about Fed policy, we talk about different strategies to make money. Although it is primarily geared toward long-term investors, I'm happy to share different strategies like this where you can make money and create more wealth for yourself and your family. Okay, well, thank you for watching, and I'll see you on the next video.